Hello everyone, my name is Connie. The article we choose to present today is Basel III Implementation and SME Financing Evidence for Emerging Markets and Developing Economies. The article talks about how the implementation of Basel III affects the financial inclusion of SME. However, the result of this article has a deficiency in some areas which we already highlighted by the article Basel III Capital Buffer and Canada Credit Union's lending, impact of the credit cycle and the business cycle. That further explain are the negative impact of implementation of Basel III on SME, access to finance, and other factors that affect the credit scoring. To continue, it's very important to know what actually Basel III is. In short, Basel III is a set of international banking regulation which designed to mitigate risk by requiring banks to maintain certain levels of reserve capital on hand. Basel III is basically built on the previous Basel I and Basel II frameworks, but it includes several key enhancements such as higher capital requirement, disclosure requirement, and others. Next, we will discuss the critique of this article, and I will pass it to Bernard.
Thank you, Connie. So, the critical point of view for the article is that the implementation of Basel III regulatory standards in emerging market and developing economies may have unintended negative consequences for SME by increasing the cost and reducing the availability of credit for these firms. The article argues that while Basel III was intended to strengthen the financial system and reduce the risk of financial crisis, the new regulatory requirements may disproportionately affect SME, which are a critical engine of economic growth in these countries. The critics suggest that policymakers need to carefully consider the potential impact of Basel III on SME financing and take steps to mitigate any adverse effects. Under Basel III, banks and financial institutions are required to hold more capital and have more stringent risk management processes, which may make them less willing to finance large projects, including those undertaken by SME. This could limit the access of SME to financing and thus reduce their ability to take over mega projects. Additionally, SME may face higher financing costs due to the increased regulatory burden and reduced competition in the banking sector. As a result, banks have become more risk-averse and are focusing on larger, more established firms rather than lending to SME. In overall, the implementation of Basel III may create challenges for SME seeking to take over mega projects, and policymakers need to consider the potential impact of the regulatory change on these firms. Next, we will discuss a little bit more critique and the factor that will affect SME financing, and I will pass it to Chen Tong to continue the slide. Thank you.
Articles, the authors critiques that the implementations of Basel III may affect the demands and supply side of SMEs, which will bring the negative impact on SME financing indirectly. So, how does it happen? Basel III tightens the lending requirements and limit the amount of credits that is available for the buyers and the suppliers of SME. So the authors critique that the SME will suffer lower demand for their products and services, so it naturally will reduce the demand for the credit to finance their operations. From that, SME will access lesser credit in future based on their profitability and financial performance. So supply chain credit or the trade credit is actually a credit that allows the buyers such as SMEs to pay for the goods or the services at a later date. However, under the Basel III implementations, banks will become more cautious and reduce their lending, so it may also reduce the amount of the trade credit available to their SME, so this will restrict the financing options available to SMEs. So The question is that why SMEs face problems in getting limited financing from banks. So one of the reasons is due to their business natures. In the point of view of lenders, most SMEs have lesser publicly available accounting informations and limited credit history for banks to determine their credit worthiness. So it will result in the higher information asymmetries and risks that discourage the lending. So based on the financing options, authors further critique that banks may shift towards more unsecured lending, that the SMEs needs to pay with higher interest rates. And also for the secure lending, banks will require more collateral from the banks from the SME. But the problem is that SMEs typically only have limited access to offer as the collateral. However, the authors also argue that SMEs in countries with better contract enforcement mechanism will saw their access to finance improve more significantly. So the authors state that the effective contract enforcement might help to mitigate the negative effects on the SME financings, that the lenders will be more confident of the repayment abilities of SMEs.
In conclusion, while the implementation of Basel III regulatory standards was intended to strengthen the financial system and reduce the risk of financial crisis, it may have unintended negative results for SMEs in emerging markets and developing economies. This is because, under Basel III, banks will shift more unsecured lending that will be charged at a higher interest rate and making it more difficult for SMEs to getting the loans. From the articles, the cost of SMEs will increase and the availability of credits for SME will decrease, and this will limit their ability to take over mega projects and declining their profitability. Also, Basel III might indirectly affect SME supply and demand side. In summary, Basel III is essential for improving the financial system, but policymakers need to consider carefully on the impact of SMEs and take necessary steps to balance the benefit and cost of the regulation. Here is our reference list. That's all our presentation. Thank you.